Welcome back to this wonderful chapter. Come to question number 28. Black company acquired 100% shares in white company on 31st December 2015. SOFP of black and white on that date were non-current asset. Under that we have tangible asset. 60,000, 35,000. 35 should be in the next line. Then investment. Shares of white company, 100% shares in white. 30,000. Loan stock of white company, 5,000. Current asset. Under that inventory, receivable, cash. So first you tick mark this loan stock of white company. That means if there is a intercompany dues, then that we will eliminate while preparing the consolidated financial statement. Then equity and liabilities. Equity share, ordinary share, retained earning, non-current liabilities, loan stock. Tick mark loan stock. So if you see loan stock of white company is 5,000 here. And in white company loan stock is 10,000. So out of 10,000, 5,000 is receivable or payable to black. So 5,000 we will cancel. Then current liabilities, bank overdraft, payable, total liability. Prepare CBS, consolidated balance sheet. Now when were the shares acquired? 31st December 2015. What is the date of the SOFP? That is also the same. So this is the date of acquisition also and the date of consolidation also. Right. This company white will become 100% subsidiary of black. So therefore they will have to consolidate the black the white's financial statement with black company, right? But first we will calculate. What we will calculate? Goodwill, okay, or gain on bargain purchase. How do we compute it? This is their separate financial statement where it is appearing at 30,000, and we have to find out what is the fair value of the identifiable net asset. Question is completely silent on the fair value of assets and liabilities of white. So how do I find out what was the identifiable net asset on the date of acquisition? We'll take the book values only. We'll take these figures only appearing in white. So either you can first take total of all assets minus all liabilities. Is it right? Or you can just add the capital and retained earning. That will also give me the same answer. So write step 1, calculation of goodwill. Do we have any NCI in this example? No. Do we have any previously acquired investment? No. So oversimplified example. Problem for the beginner. So first you check whether we have previously acquired equity interest, whether there is non-controlling interest. In this example, no. So just compare consideration transferred 30,000, fair value of identifiable net asset acquired, share capital plus retained earning is 28,500. Okay. And therefore goodwill is 1500. Goodwill is 1500. Agreed? Yes. Now dear student, next, when you acquire the other company and you have to prepare consolidation also, this is the journal entry for consolidation. It's not really required, but for understanding purpose, those who are doing consolidation first time, we are doing this consolidation entry. This is not an actual entry which is passed in the books of account, okay? This is only for understanding. So write here, only for understanding. What you will do, you will take over assets. What are the assets of White company? Tell me. Tangible asset. So tangible asset you will record in your books. That is 35,000. Then you have below, I think, inventory. Yes or no? If you understand this entry, you will understand the logic of consolidation. 8,000. Then receivable. Receivable account debit. How much is that? 9,000. Keep one line blank. And what we are going to do, we are going to cancel our investment. Against investment we are receiving so many net asset. Investment in White. Is it 30,000? Say yes. Then liability side, to loan stock. First you take over, then we will cancel it. 10,000. Okay. Is it tallying? No, we have some current liability also. To bank overdraft. To bank overdraft 3,000. And to payable 10,500. So what is happening in consolidation? These assets will be incorporated, these liabilities will be incorporated, investment account will be removed, and there is a difference which will come as goodwill. How much was goodwill? Can you tell me again? 1,000? Just 1,500. Just cross check whether in this entry also the difference is 1,500. Check. Okay. Done. Is it matching? And what we will do after we incorporate this entry, we are going to cancel the loan stock liability and loan stock asset by 5,000. So one more entry will write loan stock liability debit 5,000 to loan stock of White company 5,000. In the exam this is not required unless specifically asked, which they will not ask. This is only how the consolidation moves. So take the balance sheet of black, give the effect of this entry, and that gives you a new balance sheet, new SOFP. So write down CBS of, what is CBS? Consolidated balance sheet, or we will write SOFP. SOFP, consolidated SOFP. Consolidated SOFP of black on 31/12/2015. Right? Assets, non-current assets, tangible assets. Under tangible asset, you write down the total of the two companies, 60,000 plus 35,000. Consolidation means consolidating the financial asset, financial statement of subsidiary with parent. Then intangible asset, goodwill 1,500 already calculated. Current asset under that write inventories Inventories 18,000, 10 plus 8. Receivables 8 plus 9, 17,000. Cash at bank only 4,000 in the books of black, 4,000. Total current assets 39,000. Total of assets 135,500. Done? Say yes. Yes. Next line. Write equity and liabilities. Under equity and liabilities, write equity. And then under equity, write ordinary shares. Ordinary shares only parent company. This you don't add. This will not add. We are only going to incorporate the net assets. Retained earning 30,000. Total equity outer column 1,03,000. Now keep in mind here, we will only write parent company. Subsidiaries adjustment will not do in share capital and retained earning in this column. More about consolidation we will learn in the next chapter 1 IFRS 10. Now non-current liabilities. In non-current liabilities, I will cancel loan stock by 5,000. Loan stock 10,000 minus 5,000, 5,000. Current liabilities. Under current liabilities, bank overdraft. Only one company has bank overdraft, 3,000. Payable 14,000 plus 10,500, 24,500. Okay, right. Telled? Okay, that was just for starting concept of acquisition accounting and preparing the balance sheet. Now, dear student, one important question. 33. X Limited acquired Y Limited by transfer of its retail division. Now, this time we are acquiring Y Limited and we are transferring our retail division to them. The fair value of this retail division is 360 million and 10 lakh equity shares to the previous owners of Y. Consideration is paid in two forms. Consideration is paid in the form of transfer of a retail division, and the consideration is also paid in the form of equity share. Equity share, 10 lakh equity share, market price of equity share of X Limited, face value 10 rupees, on the date of acquisition is 350 per share. It was decided to pay the purchase consideration to the liquidator of Y Limited. So my purchase consideration would be 360 and 350. That is 710, correct? And what you have transferred? Retail segment. These are the carrying amount, these are the respective fair value. What will you de-recognize when you will pass the entry? Carrying amount or fair value? Carrying amount. Carrying amount will be de-recognized. These assets are transferred. So debit this carrying amount. Next is, on the date of acquisition, the assets liabilities of Y were as follows. Now here two columns are given, carrying amount and acquisition date fair value. Which one I will incorporate? Fair value or carrying amount? Fair value. Is it right? In this case, the difference between carrying amount and the fair value of this division for which we got 360 as consideration will be recognized in profit and loss. Okay. Question is not very difficult. Find out the purchase consideration 710 and find out the goodwill, the net asset. Can you see here net asset, fair value of net asset is 700. So what will be goodwill for this question? 10. Yes, so fast. Show the accounting entry for business combination in the books of acquirer. So one working note first you prepare. Right hand side, figures in million, rupees in million. First write point A, consideration. Under consideration write Roman 1, fair value of the assets and liabilities transferred. Fair value of the assets and liabilities transferred 360. Fair value of the assets and liabilities transferred 360. Fair value of the equity shares issued. Fair value of the equity shares issued 350. Fair value of the equity share issued 350. Total 710. Total 710. Then write fair value of asset acquired, net of fair value of liabilities assumed. Fair value of asset acquired, net of fair value of liabilities assumed 700. Okay. So therefore goodwill. How much? Is it 10? Goodwill 10. Now you have to pass journal entries. The effect of journal entries should be like this. Fair value of the assets and liabilities acquired should come into your books. 1. Carrying amount of the retail division that you have transferred must get removed. Credit. Goodwill must come. 10. Share capital issued should come, and difference between the fair value of the retail division and the carrying amount of the retail division should be recognized as profit and loss. So any such set of entries which will give this effects you can write. Okay. So we have designed one set of entries. Any other set of entries which will have the following effects you can write. You can write in one entry also everything, but will not do that. So first you write down, in the first entry we will record the fair value of the assets and liabilities taken over from Y Limited. So write down, right hand side 2 columns, debit, credit, figures in rupees in million. Start. Keep the second table in front of you, that big table, land and building, only record fair value. Ignore carrying amount 50. Plant and machinery debit 600. Equipment account debit 10. Inventory account debit 80. Receivable account debit 80. Cash and cash equivalent account debit 10. Goodwill account debit already calculated 10. 2. Last 3 items, loan account 100. 2. Trade payable 30. And 2 write down liquidator of Y Limited 710. 2 liquidator of Y Limited 710. $710 is the amount payable to liquidator. you can just write down consideration payable. Okay, 710. Any such narration you can write as a name of the account. Now what you do, you will transfer retail division to the liquidator. What is the fair value of the retail division? 360. So by transferring the retail division, we are settling 360 with the liquidator. Yes or no? So I will pass the entry for settlement in two entries. One, by transferring the retail division, and second, by issuing the shares. So in this entry, what we are doing? We are transferring retail division to the liquidator of Y. So you close your carrying amount of equipment, inventory, receivable and trade payable. These four accounts of retail division close. Write down. Keep the first table in front of you and focus on carrying amount column. Trade payable account debit 30 account, that is closed. Liquidator of Y Limited account debit 360. This is closed, 360 liability. Then to equipment account 120. To equipment account 120. To equipment account 120. Book value. To inventory account 120. Book value. To receivable account 110. So you will find these four accounts are closed. Liquidator is discharged to the extent of 360 and the difference is your gain. So that gain we will transfer to profit and loss account. Is it right? 40. Next entry, we will pay the liquidator of Y Limited shares. Liquidator of Y Limited account debit 350. To equity share capital or ordinary share capital 10. Why 10? 10 lakh share into 10 rupees means 10 million rupees in million. And to securities premium account 340. To securities premium 340. Done. Okay. Now we'll again discuss some theory part. And again a long list of question answer session will begin. Paragraph next now. Acquirer share based payment awards exchange for awards held by acquiree's employees. After question number 22. Is it there? Now the question is, the topic is, acquiree company have issued some share based payment award to its employees. Now this acquiree company is acquired by acquirer. Acquiree is acquired by acquirer. So normally what will happen, this acquirer company will exchange its own share based payment award with the share based payment award of the acquiree. Understood? Because these employees will get agitated otherwise. He will say, I have worked so hard. Last 3 years I have been working hard. Now the 4th year when the time to receive the shares have come, you have merged with other company. What about my shares? So normally then the acquirer will compensate them. They will issue their shares to them. So the question is now how to do the accounting of this acquirer share based payment award exchange for awards held by the acquiree's employee. So first what you do, write a small summary. And while discussing that long paragraph on the next page, this summary will continuously be useful to us. You have to write, calculate summary of replacement award. Write down fast. Summary replacement award. Under that, write down when there is obligation to replace. When there is obligation to replace. When there is obligation to replace. Calculate the fair value of original award on acquisition date. Calculate the fair value of original award on acquisition date. So what is you have to do? Whatever share-based payment plan is given to the employees of the acquiree company, calculate the fair value on acquisition date. Then step 2, compute fair value of replacement award, what we are offering to those employees on acquisition date. Fair value of replacement award on the acquisition date. This is what we have to pay as a replacement, and this was the fair value of original award on acquisition date. Now what I will do, I will divide the total obligation into two parts: pre-combination obligation and post-combination obligation, because this award has already run few years. Suppose the total vesting period is 4 years, they have already run 2 years or 3 years. So some portion they have already run. So that is the liability already existing on the acquisition date. So that will be treated as a part of business combination, and remaining amount I will recognize an expense for future service, right? So the formula is, for pre-combination obligation, fair value of original award, fair value of original award. So I will take this step 1 figure into vesting period completed, into vesting period completed upon higher of original vesting period, upon higher of original vesting period or new vesting period, upon higher of original vesting period or new vesting period. Is it right? Is it understandable? Higher of original vesting period or new vesting period. Suppose he has completed 2 years and he has to complete 3 more years under the replacement award. So 2 plus 3, 5 years. But suppose the original vesting period itself is 6 years, then I will take 6. But if the original vesting period is 4, then I will take 5 years. So it will become 2 by 5. Higher of the 2 we will take. And then what about the post combination? First write a note. Pre-combination obligation will be included in purchase consideration. Pre-combination obligation will be included in purchase consideration. So you have to apply IFRS 2 here. Either it will be a share-based payment reserve or it will be a share based payment liability. That depends on whether it is a equity settled or cash settled share based payment transaction. Now write down step 4. Post combination remuneration cost. Post combination remuneration cost is fair value of replacement award. That is what we have calculated here. This is now what is my obligation, and out of that obligation I have already accounted step 3 figure, correct, in my purchase consideration entry. So minus pre-combination obligation as calculated in step 3 minus pre-combination obligation as computed in step 3. It will be amortized as service cost. It will be amortized as service cost over the remaining vesting period. It will be amortized as service cost over the remaining vesting period. This adjustment also comes in many questions. You will see, if it is a long question, this itself will be one of the adjustments, right? So important aspect of this chapter. Now you want to read the whole theory quickly. Acquirer may exchange its share-based payment award, which we will call replacement award, for awards held by the employees of the acquiree, which we will call original award. Replacement award, what acquirer offers. Original award is what the acquiree had already offered to their employees. The above share-based payment award will include vested and unvested share. Vested means conditions have been fulfilled, unvested means conditions have not been fulfilled. Exchange of share option or other share-based payment awards in conjunction with the business combination are accounted for as modification of share-based payment award in accordance with IFRS 2. So we have to apply IFRS 2. In situations in which acquiree awards would expire as a consequence of the business combination, and if the acquirer replaces those awards when it is not obliged to do so. Now there can be agreements where it is mentioned in the agreement with the employee, if our company is taken over by another entity, the existing share-based payment would lapse. Possible? Yes. In spite of that, the acquirer issues the replacement award. Okay, being generous to maintain good relationship with the employee. Then what you will do, all of the market-based measure of the replacement award shall be recognized as remuneration cost in the post-combination financial statement in accordance with IFRS 2. So this, in case if they keep such award, which they are not obliged to do so, treat it as a post-combination remuneration cost. If the acquirer is obliged to replace the acquiree award, if the acquiree or the employee have the ability to enforce replacement. Now next is when you are obliged to do so. When are you obliged? If the terms of the acquisition agreement provides. In the acquisition agreement it is written the acquirer will replace the share-based payment award, or the terms of the acquiree's awards. Acquiree had told their employees, if we are taken over by other company, don't worry, you will get the share-based payment of the acquirer. Or the law of the country may say, in case if you have issued SBP and your company is being taken over, the acquirer will honor those share-based payment award. So now next paragraph says to determine portion of a replacement award that is consideration transferred for acquiree and portion that is remuneration. That is what I have dictated to you. you have to divide the total value of this replacement award into two. Pre-combination, post-combination. The acquirer shall measure both the replacement award and the original award on the grant date, and the acquiree awards in accordance with IFRS 2. The portion of replacement award attributable to pre-combination service is market-based measure of the acquiree award multiplied by the ratio of proportion of vesting period completed to the greater of total vesting period or the original vesting period of the acquiree award. This is how they write a formula in the standard, which they could have written fair value of original award into vesting period completed upon higher of original vesting period or the total vesting period. The vesting period is the period during which all the specified vesting conditions are to be satisfied. That is why I said first you write the steps, then this theory becomes very easy. The portion of non-vested replacement award attributable to post-combination service. Unvested portion will be accounted as post-combination remuneration cost in the post-combination financial statement, which is equal to the total market-based measure of the replacement award, that is a new award, minus the amount which we have attributed to pre-combination service. The acquirer shall attribute a portion of the replacement award to post-combination service if it requires post-combination service, regardless of whether employees had rendered all of the service required for their acquiree awards to vest before the acquisition date. Now, what does that mean? Suppose the original vesting period was 4 years, but the acquirer says you have to serve one more year. So what I will do? I will take total period as 4/5 for pre and 1/5 for post. Even though the original vesting period has been satisfied, but in case if is required to satisfy any additional vesting period, some portion of the expense will be allocated to post combination period. Now there is a small summary we have prepared. Check, is it there in your book? Very good. So you don't have to write. The same thing which I have dictated is presented here. How much expense will be attributed to pre-combination period? Compute the fair value multiplied by the ratio of vesting period completed as on the acquisition date to the greater of original vesting period or revised vesting period. Okay. But there is a small mistake in this note. You have to take acquisition date fair value of original award. And what is written here? Grant date fair value. Correction. Acquisition date fair value of original award. Acquisition date fair value of original award into ratio of vesting period completed as on the acquisition date to the greater of original vesting period or revised vesting period. And this portion will be treated as purchase consideration. What is post combination? Difference between fair value of the award on the date of acquisition and the value allocated to pre-combination period. This incremental amount is allocated to post-combination period as a service cost over the remaining vesting period. Right. Now we will solve few questions. Important area because in a lengthy question, this is given as an adjustment. Okay, one company acquires other company, then they will ask you to do calculation of contingent consideration, deferred consideration, share based payment adjustment, everything they will give you. This is question number 49. Acquirer A Limited issues a replacement award under a business combination transaction. Market based measurement of which under IFRS 2 is rupees 10 million. The original award of the acquiree has a market based measure of rupees 9 million. So what is the difference between this 10 million and 9 million? 9 is original award fair value. 10 is replacement award fair value. Under the replacement award, the employees are not required to provide any further service after the acquisition date, and vesting period has been completed under the acquiree's award. Should the additional obligation be treated as a liability assumed in business combination? No. Read again. Acquirer A Limited issues a replacement award under business combination transaction. Market based measurement of which under IFRS 2 is rupees 10 million. So this is the fair value of the replacement award. New. Original award is 9 million. Under the replacement award, the employees are not required to provide any further service after the acquisition date, and vesting period has been completed under the acquiree's award. So how much will you recognize as pre-combination expense? Original award fair value 9 into vesting period completed upon total vesting period. Vesting period completed and total vesting period are same. So 9 will be pre-combination. But the fair value of the replaced award is 10 million. So what you are paying is 10. And what you are accounting as pre-combination expense is 9. So where will that 1 million be treated? That 1 million will be treated as a post-combination expense. So write down. This is what was mentioned also somewhere, that sometimes even after the vesting period is complete, we may have to recognize additional expense. Answer. The pre-combination obligation is, yes, it is an expense. Now you are recording 9 as SBP reserve and you are going to pay 10. So one, you treat it as an expense.
If the employees were shareholders, then additional consideration. In this particular case.
Employees are?
If the employees were shareholders, then this would be additional consideration. Because they don't have to serve any further, but still I am paying them more.
So whether employees are shareholder, does it matter? Does not matter if the employees were the shareholders.
Then it would be additional consideration.
This in any case, this is extra consideration we are paying. We are replacing award of 9 million with an award of 10 million. So 1 million is the extra consideration we are paying, which we have to account as a post remuneration or post combination expense. Up to, in business combination, we will only record up to 9. But it's not contingent consideration. It is a
condition
amount specified already.
condition price to employment.
But this is not a contingent consideration. There is no contingency involved. All things are logged. Numbers are fixed. Pre-combination obligation is fair value of original award on acquisition date. That is rupees 9 million. As the vesting period is complete, the pre-combination obligation will be included in purchase consideration. Pre-combination obligation will be included in purchase consideration. Therefore, post-combination remuneration cost is equal to fair value of the replacement award minus pre-combination obligation as calculated above. So, pre-combination obligation is 9 million. The differential amount you transfer to P&L account, 10 minus 1, 9, 1. One more question. This question is printed in 23 number, come to 23, lot of pages before. Green Limited acquired Pollution Limited. As a part of the arrangement, Green Limited had to replace the Pollution Limited existing equity settled award. Original award specify a vesting period of 5 years. As on the acquisition date, employees have already rendered 2 years of service. As required, Green Limited replaced the original award with its own SBP award. Under the replacement award, the vesting period is reduced to 2 years. 2 years from the acquisition date. So 2 already completed, plus 2 more, 4. But the original vesting period is 5. So we are going to treat 2 by 5 of the fair value of original award as pre-combination remuneration expense. So market value measure of the award on the acquisition date is 500, 600. As on acquisition date, all awards are expected to vest. Simple question. What will be the amount of pre-combination expense or liability, and what will be the amount of post-combination? 2 by 5 into 500 pre-combination equal to, and post-combination equal to 400. 600 minus 200. Right. You need not write formula every time. Write formula once. But in the exam, yes, you should write formula also. Some examiner give 1 mark for writing formula, and some deduct 2 marks for not writing formula. Yes, I have seen that paper. Fair value of original award into vesting period completed upon higher of the original vesting period or new vesting period. So you can directly write down 500 into 2 by 5. This obligation existed on the date of acquisition. Then write down Step 2, post combination remuneration cost. Post combination remuneration cost is equal to fair value of replacement award minus pre-combination obligation. Fair value of replacement award minus pre-combination obligation. 600 minus 200 is 400. Note, it will be amortized as employee service cost over the remaining vesting period of 2 years. One more question. Question number 50. Acquirer A Limited issues a replacement award under a business combination transaction, market based measurement of which under IFRS 2 is rupees 10 million. The employees are required to render 2-year service after business combination to be entitled to the award. The original award has a market based measure of 9 million and a vesting period of 5 years. Which all the employees have completed. Should the additional obligation be treated as a liability assumed in a business combination? No. What is the total vesting period? 7. And how much he has completed? 5. So 5 by 7 into 9 is pre-combination. 10 minus pre-combination is post-combination. So your answer no was for which no? Liability means your share-based payment obligation. Additional. So the question is, if not, allocate the obligation into pre-combination obligation and post-combination obligation. So actually this liability will be divided into two. Some portion will go to pre-combination and some portion will go to post-combination, because the employee will be required to serve 2 more years. So the total number of vesting period for the employee will become 7 now, and he has only completed 5. So then I will only recognize the proportionate amount in pre-combination. So write down the formula, or don't write formula, directly write pre-combination obligation is equal to 9 into 5 by 7. 9 into 5 by 7 post combination, write down remuneration equal to post combination remuneration equal to 10 minus 6.43. 10 minus 6.43 million is equal to 3.57 million is equal to 3.57 million. One more question. 51. Acquirer A Limited replacement award under a business combination transaction, the market based measurement of which under IFRS 2 is rupees 10 million. employees are not required to render any service after business combination. The original award of the acquiree has a market-based measure of 9 million on the date of acquisition and a vesting period of 5 years, of which the employees have completed 2 years only. Should the additional obligation be treated as a liability assumed in business combination? So what is the answer? First I will compute how much amount will be treated as pre-combination obligation. So write down step 1, pre-combination obligation. Pre-combination obligation will be 2 by 5. 2 years completed. 5 he had to complete. So that means the proportionate amount for which we are obliged right now is only 2 by 5 into 9, 3.6. But the post combination value of the replacement award is 10. So what I will do, 10 minus 3.60, 6.40 million will be recognized immediately. Will be recognized immediately. So see how the questions are changing. Now come to the next part, theory book, theory part, non-replacement award. Three situations we have to understand. 2 we have understood. One was replacement award. Under that we discussed voluntary. That means even if you are not required to replace the award, you replaced it. And second is mandatory. Either the terms of the agreement provides, law provides, agreement with employees provide, we have done. Second is non-replacement now, which is the current topic. Non-replacement award means we are not going to replace. We are not going to replace. Is it right? So who had given the award? The acquiree. So the acquiree will issue shares. Acquiree will issue shares. In case if the acquiree is not liquidated, who is going to issue the shares? The acquiree. An acquiree will issue share to their employees. We are not going to issue share to the employee. These shares will be issued by acquiree. Correct? So it will be belonging to whom? To us or to outsiders? Outsider. So it will be added to NCI because it will become part of NCI. So the value of such awards which we are not replacing will be added to NCI portion. It will belong to outside shareholders. So outside shareholders in the subsidiary will increase. Okay. So adjustment will be made in NCI. So non-replacement award, acquiree may have outstanding SBP transaction that acquirer does not exchange for its SBP. Now here also we have two types of situation. One is vested. Vested means conditions have been satisfied. So those acquiree SBP transactions are part of NCI in the acquiree and are measured at their market based measure. And if unvested, then they are measured at their market based measure as if the acquisition date were the grant date. So you will take the fair value on acquisition date and then multiply it by the number of years complete upon the total vesting period. Okay. So market based measure of unvested share based payment transaction, similar to what we did in the previous 2-3 question, is allocated to NCI on the basis of the ratio of portion of vesting period completed to the greater of the total vesting period and the original vesting period of the share based payment transaction. Vested will be fully allocated to NCI. Unvested will be proportionately allocated to NCI. That proportion will be calculated using the same formula. Fair value of original award on acquisition date into number of years complete upon higher of the two, total vesting period or original vesting period. The balance is allocated to post combination service. Is the summary written in your book? No. I think yes. Vested share. Value credited to share based payment reserve will be classified as NCI. Unvested. Pre-combination period is considered as a part of NCI. Pre-combination period calculation is fair value of original award on acquisition date into vesting period complete upon higher of the total vesting period or new vesting period. Post combination period is recorded as one effect employee cost and second effect it will be added to NCI. Instead of share based payment reserve as a part of NCI, because NCI will also appear in the balance sheet under the head equity. Share based payment reserve also appears as equity, so it will be added in NCI. Now there is a small question 24. So first we will solve, then we will decide whether to continue or go home. But first I need to solve. This question will give you an understanding of non-replacement award. So we have tried to take examples on all the provisions. P is a real estate company. It acquires Q, another construction company which has an existing equity settled share based payment scheme. The awards vest after 5 years of employee service. At the acquisition date, company Q's employees have rendered 2 years of service. None of the awards are vested at the acquisition date. P did not replace the existing share based payment scheme but reduced the remaining vesting period from 3 years to 2 years. Company P determines that the market based measure of the award at the acquisition date is 500 INR based on measurement principle and condition given in IFRS 2. So now the question is, what is the treatment? So we will have to divide the fair value into two parts: pre-combination period, post-combination period. Pre-combination period will be allocated to NCI. So write down first portion allocable to pre-combination period. Portion allocable to pre-combination period. $500 into 2 by 5. Why 2 by 5? 2 years completed, 5 is higher of the two. Original vesting period was 5 years and the revised vesting period is 4 years. So I will take higher of the two. And this amount is computed on original vesting period. Write little fast. The remaining expense, which is 500 minus 300, is accounted over the remaining vesting period of 2 years as compensation expense. Now we will continue tomorrow.